So, good afternoon. Welcome to Tax Assist and welcome to our budget webinar. Thank you all for joining us. We'll start with some quick intros. So my name is Darren Moore and I'm Group Commercial Director for Tax Assist.
I'm Andy Gibbs, I'm Group Technical Manager. So,
plans for today is to try and run through fairly quickly a summary of what happened last week. So just some background. So who are Tax Assist? A lot of you will be Tax Assist clients, so will know us anyway. For those of you that aren't, we are a network of accountants operating across the UK. So we look after about 80,000 small business clients, predominantly from about 400 locations. And our job, Andy and myself here centrally, is to support our network in lots of different ways, including things like budget content. And last week was a very busy week. So what we're covering today is a pretty quick run through of what happened. Budgets are always quite involved, and this one actually had an awful lot of content. But we're going to break it down into two parts. The first part will be around COVID support. We always expected the budget would factor in an awful lot of COVID support information and would extend perhaps COVID support, which it has done. So we'll talk through that very quickly because there's quite a bit of it in there that's important. And we'll talk about the tax changes, which weren't as significant as some were expecting, but are still important to run through. So we're going to try and give you a quick overview of what we see as key elements in the next half hour or so. We are recording this, so you are able to go back onto our website and see this afterwards if you need to and revisit. And we will be taking questions at the end. So please do use the chat facility and we'll come back and see how much time we have at the end to go through questions if you have them. So that's the planned running order. We're going to start with just a quick summary of what happened. We will go through a little bit more detail between Andy and myself, but just some headlines. So the budget was delivered last Wednesday, as I'm sure you're all aware, and there's been a huge amount of press coverage on this already. It was always going to be a bit of a juggling act for the Chancellor. You'll all have seen the headlines in terms of debt levels at the moment and record levels in a post-war environment anyway. So there was always going to be a balance between supporting the economy, supporting funding of that huge amount of debt that's been created, and making sure that we had a path out of COVID. And it was, I suspect, a very difficult balancing act, and you'll have your own views on how successful that's been. We'll just talk through some of those key measures. Not a huge number of tax changes, but it's really important to understand that actually the tax burden overall is increasing, because in addition to some specific changes, which we'll talk about, probably in some ways the biggest news was what didn't happen. And what hasn't happened is increases in certain allowances, particularly personal allowances. And there's a fix for the next 5 tax years, which sounds quite modest, but actually is quite significant in terms of overall tax take. So I think a lot of people are commenting of just how high that tax burden will be after that 5-year period. There's a long way to go through that 5 years, of course. So the personal tax treatment from an income tax point of view was quite important. And there was a certain number of concessions around things like VAT, and we'll talk about that later. The 5% reduced rate has been extended, which will be important for many. There was a bit of news on companies. There was a new, what's called a super deduction on capital investment. And we'll talk a little bit later about what that means and how important that might be. What is certainly important for many will be the new 3-year carryback of losses for businesses. Again, we'll talk about that in a bit more depth, but that's quite significant for many because inevitably an awful lot of businesses are struggling and have been for the last year. There will be losses incurred, and how they're relieved and how tax monies can be claimed back as a result of that will be important to you. So we'll cover that in a little bit of detail as well. And we'll also speculate a little bit about what may be happening in the future, because there are some consultations happening. As with most budgets, the devil is in the detail, and there is still more expected. So we'll speculate a little bit about that as we go through as well. Okay. So, Andy.
Thanks, Darren. We start off by having a look at some of the measures that were announced to support in respect of COVID support. One of the most important ones was the announcement for the self-employed. So there is a self-employed grant scheme, and we've been waiting a while to see whether there was going to be a 4th grant, because there's already been 3 grants to help support self-employed individuals. And the good news is the Chancellor did say that there would be a 4th and also a 5th grant. So the 4th grant will come out from covering the period from the 1st of February up to the 30th of April. And we assume that you'll be able to start making claims from April onwards. We have produced some guidance on our website, which shows how to make the claims for previous grant instalments. And we'll be doing the same for the 4th and 5th when we've got more detail. We haven't got all details yet, but as a brief run through of the things that we know, what will the fourth grant amount to? Well, it's going to be 80% of 3 months average trading profits, and it's going to be capped at £7,500. That's the maximum grant claim that can be taken, but for some people it will be less than that because it will depend on your average traded profits. There is a couple of restrictions in there, a couple of things to watch. Trading profits can't be more than £50,000, and they must be more than half of total income, which really means you can't have too much investment income in your total income for the year. It will either be for the tax year 2019-20, which is a change we'll come on to, or the average of the tax years 2016-17 through to 2019-20. Another thing that we'll be preparing is a grant estimator. So we hope to have that done sometime this week. You'll be able to come along to our website, put your figures in, and it will give you an estimate of the potential fourth grant that you may be able to claim if you're self-employed. You must have traded in both 2019-20, and one of the rules is that you must have submitted your tax return by the 2nd of March 2021, and you must continue to trade in the 2021 tax year as well. It's good news, more support for the economy, which is much needed. And in terms of the people that have previously been forgotten, there are still gaps. There are still people that aren't getting the support that they need, but at least in this small measure, there is some hope for some people who are now going to be included with more support. By including the 2019-20 tax return, HMRC estimate that an additional 300,000 people that started self-employment in 2019-20 will now qualify for the remaining grant. So that's good news. They also estimate that another 300,000 individuals who previously were restricted from being able to claim because they failed one of the criteria will now be able to make claims. We have to take that with a bit of a pinch of salt because those are estimated figures from HMRC, but the announcement that hundreds of thousands of extra people will be able to get support that they deserve and need is really good news. There are also a few conditions that need to be met and some declarations when you come to make your grant, basically saying that you reasonably believe you'll have a significant reduction in your trading profits due to COVID. So if you are self-employed and you are looking out for that fourth grant, it's good news and more help is on the way. As we said, we've got up there our grant calculator, which was for the third grant, and we will be releasing ones for the fourth and also one for the fifth, but when we get more detail. So briefly on to the fifth grant. This one will be more tricky. This one will have a few more caveats with it, and we haven't got the draft law written yet for us to look at in any way. But what we know is that it will cover the period from the 1st of May up to the 30th of September. And from what we've been told, that's when those self-employed grants will end. So as with all COVID support, it will be time limited, and that now seems to be when it will truly end. The amount of the fifth grant, though, is going to be determined by how much your trading profits has fallen. And again, unfortunately, we haven't got the granular details of exactly what they mean by that. What they have said is that the fifth grant will be worth 80% of 3 months average trading profits, capped at £7,500 for sole traders whose turnover reduction has been 30% or more. So it's that here they've introduced this new key step. Your turnover has to drop by 30% or more to get the full grant. Where you don't meet that criteria, it will only be 30% of 3 months average trading profit, capped at 2,850. So that's where turnover has reduced by less than 30%. As soon as we get more details of exactly how they're going to measure that, we'll provide more details and put that on our website. The hand-in-hand support scheme that the government has announced for COVID support with the self-employed support scheme is the furlough scheme, which people will be familiar with. So self-employment scheme is really for self-employed individuals and maybe partners of a trading partnership. The furlough scheme is to support employees and keep them in employment. And one of the themes of the budget was maintaining employment, maintaining support for employees. And there was more good news there. So the COVID furlough scheme has been extended, and instead of closing at the end of April when it was supposed to close, it will now like the self-employment scheme, it will carry on through to the end of September. But as with the self-employment fifth grant, the furlough scheme in its extended form will see less support being provided. So the financial support is anticipated to reduce over time. So although employees will continue to receive 80% of their pay for hours not worked, subject to a cap. So this is for the employees where they're not working, the furlough support comes in to support the hours that they're not working and replace their pay. But over time, at the moment, employers are only having to contribute pension contributions towards some of those things and some taxes. But over time, the support will have to be increased. So employers will start to have to contribute 10% of unworked hours in July and 20% in August and September. We will be providing more details and sending more details out on that, but that's just a rough overview of what we are expecting to come in. Another quick point to make is that the eligibility criteria will change, so that under the new scheme, so from claims from the 1st of May 2021 onwards, we can include employees who are employed on the 2nd of March 2021, subject to them being on the right payroll submissions. Up to this point, up to the 30th of April under the older scheme, they had to be employed on the 30th of October. So that will again mean that some employees who previously couldn't claim for furlough, their employers now will be able to claim. So again, really good news for employees and employers as it provides more support. Another announcement that was made for England was restart grants. So this is where your local authority from your council will provide you with grants where you have business premises. So again, much needed support. And as that rolls out, we'll keep you updated. Non-essential retailers, as well as the hospitality and leisure sectors who have been most hard hit by COVID, will potentially be able to benefit. So non-essential retail businesses will be able to claim cash grants of up to £6,000 per premises. But the businesses that are most affected by the lockdown, so hospitality, accommodation, leisure, personal care, gym businesses, they can claim up to £18,000 per premise. So that would be good news for those affected business clients.
And I think it's important to note on all of these schemes, there are a number of grant schemes around already, and we expect to see more grant schemes over time. As more and more funds get channeled through local authorities, our advice to you would be to keep an eye on those local authority websites. As more and more money is delivered that way, it will be really up to businesses in some cases to spot those opportunities. So that's just a bit of advice from us really, to keep an eye on those sites, because different authorities are choosing to spend monies in different ways with different priorities. So it's very difficult to get a UK-wide picture. Another aspect of COVID support over the last 12 months has been around trying to support borrowings into businesses, and we saw some changes coming out of the budget that are worth talking about because they have been incredibly well used up to now, and I'll come on to some of the existing schemes in a second. The existing schemes are now going to be replaced by what's called a recovery loan scheme, and that's going to be launched on 6th of April, and that will run in theory until December 2021. Our expectations would be that that possibly may be extended depending on need, but certainly it's going to be there for a while. And it's there for businesses affected by COVID and providing funds for legitimate business purpose, which is a fairly wide definition they've given, including managing cash flow, investment and growth, but it could include a whole number of uses. And that will be quite a wide range of funding, 25,000 up to 10 million. And there will be some flexible invoice and asset finance in there at lower start points. We haven't got the full details of this yet either. As we said at the start, the devil is still in the detail. But this looks like another government-backed scheme that we suspect will be hugely popular. So it's worth looking out for this in terms of how it will work. Certainly previous schemes have been most advantageous. We expect this one will be similar, perhaps not quite as beneficial, quite as generous, but it's still going to be something that's going to be well used. So as and when the funders have got together with the British Bank, who are organising this, we'll send out more details to you once they're announced. Thanks, Andy. What they're replacing, as some of you I'm sure will have access to already, are bounce back loans and coronavirus business interruption loan schemes, or CBILS as they've been called. So those schemes are winding up at the end of March, so the end of this month. You can roll some of those facilities into new facilities potentially. You can request top-ups under those facilities. If you are considering additional borrowing and you haven't taken out one of these scheme loans already, we would recommend you look at them. Not everyone wants to borrow, not everyone wants to create debt, we understand that, but they are very, very beneficial loan arrangements with that government backing. And there's lots of flexibility around repayment, interest, etc., very low cost borrowing, huge amounts of money, tens of billions already borrowed through these schemes. But if there is an interest in them, that window is going to close soon, and lenders are going to start to focus on the recovery loan scheme almost certainly. So just bear in mind that these schemes are still there if you need to access them, because there are lots of benefits to them. Alongside supporting businesses in different ways, there's also a real drive to try to get re-engagement for the employment market, and a big push towards apprenticeship and traineeships. Now, this is an ongoing story. We saw a lot of this announced last year, but the government, I think, has been quite disappointed, it seems, in the take-up, or relatively low take-up, of things like Kickstart schemes and other apprenticeship schemes that have been introduced in the past. So from April this year, there will be new schemes in place which will increase the amount depending on age per apprentice, so attractive to employers. And that's in addition to some existing schemes where there's existing payment structures in place. There is a lot of funding going into this, and I suspect there will be far more investment over time, particularly in the 16 to 24 age group, where there are higher levels of unemployment at the moment. So again, if your employer's out there and you're looking at these schemes, do look at some of these details. There is more to come, but it's very clear that the government is committed to fund those apprenticeship and traineeship opportunities. So something for employers to bear in mind, and we'll have more information on that when they announce more over time. And a relatively minor part, but something we thought we'd mention, because it was quite well publicised off the back of the budget, is what they've called a help to grow scheme. Now, there are two parts to that. There's a training element and a digital element. The idea being that they provide access to support businesses as they grow. The government seemingly wants to help almost mentor businesses to try to help them recover off the back of everything that's happening at the moment. And let's hope we are almost in that recovery phase. So again, this is one to look out for. In theory, some very heavily subsidized, valuable training programs. So that will be management training, some training on the digital and software side, plus potentially some discounted software as well. So that could give small businesses, medium-sized businesses, great access to training, help, and some software. So we're looking out for details of that. But again, it's something to bear in mind, because I think a lot of businesses are going to have to reassess where they are, rethink their business plans, and having some support and training around that may be useful. So that's really on the COVID side. There were some tax changes as well, which I'll let Andy start going through.
Thanks, Darren. Firstly, on to corporation tax. So that was really the headline grabber from the budget. A big proposed increase to the main headline rate of corporation tax, up from 19 to 25%, but that will be delayed till April 2023. So a bit of time to plan for that rise, but tax changes, tax rises are on the horizon now, and the Chancellor did start to pencil in when they will start to fall. The good news for small businesses is that there will be an introduced new small profits rate of 19% for companies with annual profits of £50,000 or less. So for smaller businesses, their corporation tax rate may not change that much. Where profits are more than £50,000, there will be a taper up to £250,000 before you go on to the full main rate of corporation tax. So it's been about since 2015 or so since we had these sorts of marginal rates to contend with. They're now back on the agenda, as are rises to corporation tax in general. So that will be unwelcome news for some businesses, and it's a signal of direction, I think, as to where they're going to be raising taxes. Big business seem to be the first hit there, but there is still some support for smaller businesses, which is good news. The other headline grabber was something called the temporary super deduction. And what that specifically is relating to is where businesses spend on capital expenditure. So things which have enduring benefits, things that you keep for a long time, plant, machinery, laptops, those sorts of things. Where expenditure is capital within certain categories, there will be a new super deduction. There will be exclusions. For example, it won't apply to cars. And as with most capital allowances, it won't apply to things like buildings. So there will be some things which aren't impacted. And our general thought on this is that the big beneficiaries here will be big, what they call capital intensive businesses. So ones which spend a lot of money on big capital plant and infrastructure. So maybe less for the small business there. The tax benefits will be less, unfortunately, for those businesses as compared to the already fairly generous system for capital relief. So for most small businesses, when they spend money on capital expenditure on qualifying plant and machinery, they can normally take an effective 100% deduction against their profits by making use of an allowance called the annual investment allowance. For most smaller businesses, that will cover most of their capital expenditure. So they already effectively get a 19% effective deduction. How the super deduction will work is where you do have qualifying plant and machinery, you can increase the allowance by 130%. So if you spend £100, effectively it's grossed up to £130, and then you will then pay the main corporation tax, or you will have relief at the main corporation tax with 19%. And how that will pan out is that effectively you get a reduction in tax of £24.70 for every £100 spent. That's sort of how it works out. And as we said before, currently you get £19 or effectively 19%. So there is definitely an increase and definitely a benefit where you can claim that, but it isn't as much as where you're a larger company and you will get both a timing benefit as well as a benefit in terms of the amount of the relief as well. So this is a bold new plan, and the Chancellor did say it was a bold new plan. They've never tried anything like this. They need to see how it will work to really determine whether it's effective, but less useful for smaller businesses, but still something that we should claim wherever we can. The main support that was announced was that there will be extended loss carryback rules for businesses. So this applies both for companies, and it also applies for sole traders, people who don't run their business through a company. And this will allow them to carry back their losses for 3 years. So ordinarily, you do your books, you do your accounts, and you work out your loss. And with that loss, there's a number of things that you can do. In most cases, either for a company or a sole trader, you can carry that loss back a year. Under these new rules, you'll be able to carry it back 3 years. And that will potentially be more beneficial. So it will give more options. And the real takeaway from that we think you should just realise is if you did have a loss in your accounting period, or you think you may have a loss, then get your accounts done as soon as you possibly can. Really get the books done quickly, because it will allow you to realise that loss earlier than you otherwise would. And we think that's the main takeaway from that. There was also some announcements, as Darren said earlier, on VAT. So last year, a new 5% reduced rate of VAT was introduced for certain businesses which relate to supplies of hospitality, hotel, holiday accommodation, and admission to certain attractions. And the good news is that because of the huge impact that COVID's had on those sectors, the 5% reduced rate will now be extended through to September 2021. And then they'll replace that 5% rate with a 12.5% rate. So there isn't a complete loss of the beneficial rate. And that will apply from the 1st of October through to the 31st of March 22. Then we're going to revert to the standard rate of VAT of 20%. So again, good support there for those sectors that will keep their prices lower, which will drive businesses as we come through the recovery, hopefully through the summer. And lastly, on individuals, a bit of a non-headline in many ways, because the headline in many ways was freezes. So people think, well, that's okay. Corporation tax has gone up, individual tax hasn't. But the devil's in the detail there, because they've effectively frozen the personal allowance. That's the allowance that you have when you have earned income, the amount that you can have as earned income without actually paying any tax. That's going to be frozen for 5 years. Well, that's effectively a real-time tax increase. And the same with the national insurance limit, which is incredibly important revenue source for the government, that will also be frozen for 5 years. Capital gains tax. We expected quite a few announcements on capital gains tax, and it was being discussed all in the press as it always is. But in the end, very few changes were made in the budget, and they announced that the allowance that you can make capital gains when you sell assets like property, rental properties, and you have gains, the level before you start paying tax will also be frozen for the next 5 years through to 25, 26, which again represents a real-time tax increase. And a few other changes: stamp duty land tax, which is paid in England and Northern Ireland. Home owners and purchasers of property have been benefiting from a nil rate threshold up to £500,000. The good news was that will now extend through to the 30th of June rather than ending when it was intended, and that then will also be extended further beyond the 30th of June, where it will drop from the current £500,000 down to 250,000, and then it will revert to the level that it always has been at 125,000 from September 21 onwards. Inheritance tax was another budget headline that didn't really come about because people were expecting lots of changes and they weren't. And the nil threshold and the residence nil rate band, the amounts that you can gift but when you pass away, will also be frozen for 5 years, which will hit people again as inflation creeps up. And on pensions, again, many announcements anticipated but none made. But the announcement was the amount that you can receive tax-free when you start to crystallise your benefits, when you start to take private pensions or defined benefit pensions, when you start to take them, it's tested against a level, and above a certain level you'll pay additional rates of tax. That level will be frozen at £1,073,100. So that will again over time affect more and more people.
Thanks, Andy. So we thought we'd wrap up with just an overview of the budget from our point of view. And I think I started by saying it was always going to be an incredibly difficult budget and a very unusual budget because of circumstances. Huge amounts of debt, the obvious challenges in the economy, the huge personal challenges and difficulties that we're all going through. And because of that, the COVID is largely COVID related. And we've talked about some of those things as we've gone through. There were several more minor elements in there, but we've covered the headlines. And in terms of action points, I think that's the first thing for most people, is to look at those COVID schemes, things like the furloughing scheme, the self-employed scheme, massively important to the economy, hugely important, I'm sure, to many of you. So those extensions will be very, very well received. What will happen come the end of September? Will furloughing just cease? Will there be that almost cliff edge approach to this support? We simply don't know. I think a lot will depend on the government's roadmap and what happens around that recovery that's being talked about over the next 6 months. We will all hope that, of course, that happens. On the tax side, it was a bit of a non-event in some ways. We've covered the headlines. There weren't that many of them. Normally a budget is quite tax focused, but that wasn't the case this time around. And as Andy has said, I think the news really was more about what wasn't there in terms of things that have been speculated about and anticipated. Capital gains tax changes, inheritance tax changes, pension changes, all of those things were talked about in the media endlessly. None of them happen. So what does that mean? Does it mean that they're off the agenda full stop? Our thinking is probably not. This was always going to be a very careful path for the Chancellor to tread. He was always going to have to try and balance that need to support recovery and start that general move towards recovering on the tax side. And things like the freezing of allowances seems innocuous, but actually does significantly increase the tax burden over time. What's more interesting to us, I think, is what happens in the future. The debt that's been created will take a long time to repay, potentially. That debt will have to be recovered through not just some marginal changes to taxes they've done in this budget. We think some more structural changes to tax, whatever they may look like. So I think the lessons for all of us are, in the short term, the COVID response is critical, and we'll continue to help support our clients on that because there is a lot of information still coming out. On the tax side, the priority is probably around losses. That loss relief piece will be valuable to many. So as Andy said, getting your accounts done early, crystallizing or quantifying those losses talking to us, your accountants, about carrying them back to generate a tax refund. That will help from a cash point of view. That will be important. Thereafter, we'll have to see what happens. We think there'll be lots of tax changes coming. That will increase the need for tax planning. We'll be there to support you with that. There'll be issues around marginal rates of tax. There'll be key decisions that you need to think about that will have tax consequences. So we will support you with that. And the funding piece will be important as well. And things like some of the deferral of taxes we've seen, things like some of the new loan schemes I've mentioned, that will all be important as well. So we're in very unusual times. I think this budget was a start, but we think there's a lot more to come, as I say. We will do our bit to communicate with you in the normal channels we've been doing. So please do stay in touch. Please do look at our website. We will be sending out updates to clients on a regular basis, and we'll be making sure that our website is up to date. So hopefully over time, as we see more, as we hear more, as we understand more, we'll be there to help you, and you can look and ask us questions as you need to. In terms of wrapping this up, I don't think we've got too much time for questions. So what I would say is if you have got anything you want to cover, we've had a very quick run through, no more than that. So please do feel free to come back to us afterwards with questions, and we will do our best to answer those if we can. Please do look out for future communications from us. Please do look at our website. Our network is very much open for business. If you're a client and you've got any questions, of course, talk to your accountant and they'll help you. If you're not a client, we're absolutely open and here to help. Happy to have some initial meetings to talk through with you. So please do use that as well. But I think that's probably everything from me. Andy, any final points from yourself?
No, thanks.
So all I would say is thank you very much for joining us. Thank you for your time. As I say, if there are any questions, please get back to us. But please do stay safe in these difficult times, and we hope to see you again. Thank you.